Hello everyone. In my today's presentation, I will be dealing with adjustments in final accounts, and the specific adjustment which I have selected is provision for bad debts. Now, there are different ways in which provision for bad debts can be tackled in our final accounts. But first, we need to understand the concept of bad debts. What are bad debts? A company or any company or a partnership firm or a proprietorship concern will be making credit sales throughout the year. And at the end of the accounting period, all the debtor balances are calculated as per the ledger and they are posted in the balance sheet of the final accounts of the company. But there could be some debtors from which the money which is supposed to be got back is not realized, and the company is sure that it will not get back the money. And that money or the amount which is unrealized from the debtors is to be declared as a loss and has to be written off or subtracted from the profit while preparing the profit and loss account. So bad debts are basically unrealized amounts from debtors in the event of the same becoming insolvent or when it fails to make a payment, or simply when the company, again a company or a proprietorship firm or a partnership firm, etc., is sure that the required amount will not be received and will have to be treated as a loss. It is definitely known that the amount recoverable from a debtor cannot be realized at all, and the same may be treated as a business loss and it should be accounted for accordingly. These bad debts, as I have said before, will appear as a loss and shall be posted on the debit side of the profit and loss account. We also say the bad debts are charged against the profit. Charged against profit means while coming to the figure of net profit, it will appear on the debit side of our profit and loss account, so that while calculating the profit figure, that bad debts will be treated as a loss and shall be deducted while preparing or arriving at the figure of net profit. Now this is what we have understood about bad debts. Now we come to provision for bad debts, and we need to understand the basic meaning of this provision and why it is created. In case of bad debts, we are sure, or the company or the proprietorship concern, etc., is sure that a certain amount of money will definitely not come back. But there could be some debtors from which the concerned company might be unsure that a certain amount of money might or might not come back. It cannot tell it with surety. In such a case, a provision for bad debt is created. See, at the end of each accounting period, a company or firm knows that it will suffer a loss due to bad debts in the future. But an accurate estimate of apprehended bad debts cannot be made. Hence, to ascertain the accurate profit, a provision for bad debts is created, and again it is charged against the profit in the profit and loss account. So this provision has to be made, and the requirement of maintaining this provision is coming from the conservatism concept of accounting. Let us now understand what this conservatism concept of accounting states. Conservatism concept, also known as the prudence concept. This accounting concept states, along with other points, that if there is an anticipation that a debt may not be realized, a specific amount is set aside from profit as provision for doubtful debts. In this context, let me tell you that this provision for bad debts sometimes is also referred to as provision for doubtful debts. Now, what does this concept say? This concept states that if you or the company is making a loss or anticipating that a loss will be made against certain unrealizable amount, then loss of that particular amount will have to be shown in the specific accounting year to which this unrealizable amount belongs. For example, if an amount is unrecoverable in the present financial year, let us say 2019-20, it has to be shown in that year only. And so a provision will have to be made. Now, how we treat provision for bad debts in final accounts? There are two ways, depending whether it is a new provision or an old provision. A new provision for bad debts will have to be created in the present financial year, whereas an old provision is carried forward from the previous financial year, which means it might have got created, rather it has got created in some other financial year and is being carried forward. Now, old provision will appear in the trial balance. A new provision will not appear in the trial balance, because new provision will be created in the present financial year or any particular financial year after the preparation of trial balance. In this presentation, we will deal with the new provision only. To understand this concept, let us go through an example where an extract from a trial balance of a company as at 31st March 2019 is given. The trial balance gives sundry debtors balance as 3,10,000, bad debts as 5,000. And the adjustments say write off further bad debts for rupees 10,000 and create a provision for bad debts at 5%. Now we look into the solution and how we will tackle the provision for bad debts and subsequently the further bad debts which is mentioned in the adjustment section. Now we have a bad debts figure of 5,000 appearing in our trial balance, which means this particular bad debts account has already been adjusted with the sundry debtors. So we need not bother about it. We will be required to take into account the bad debts appearing in the adjustments. For this, we will follow two simple steps. First, we will deduct this rupees 10,000 from sundry debtors. The balance whatever we will get, we will take that balancing figure of sundry debtors, and from that balance we will calculate 5%, and the figure which we will obtain is our provision for bad debts. Remember, these two steps are specifically for calculating the provision figure, but this 10,000 bad debts will always appear on the profit and loss account debit side, and the provision will also appear in the debit side of our profit and loss account, which is specifically as per our conservatism concept which we have discussed. Let us go through the working notes now. The step 1 was deduction of the further bad debts which was appearing in our adjustment section from the sundry debtors, which is done. The sundry debtors value given in trial balance was 3,10,000, and from there 10,000 rupees of bad debts has been deducted, and the debtors balance figure which we get is rupees 3 lakhs. Now provision for bad debts is created on this debtors balance of rupees 3 lakh, which is 5% of rupees 3 lakhs, coming to 15,000. This provision figure is posted on the debit side of our profit and loss account and subsequently deducted from the sundry debtors balance in our balance sheet, which we will be seeing now. Remember one thing, the bad debts figure which had appeared in the trial balance, this will in no way will get involved while calculating the provision, because any particular account head or item which is appearing in the trial balance is already adjusted with the specific ledger. The extract of the profit and loss account is shown in this slide. Here first we make the posting of the bad debts which is appearing in the trial balance. 2 bad debts, 5,000. To this, the bad debts appearing in the adjustment is added. This is the way in which we will be writing or solving the specific sum related to our final accounts where the bad debts and the further bad debts etc. will come. So the total figure now is 15,000. To this, the already calculated figure of 15,000 is added. Add provision for bad debts 15,000 and the total figure comes to 30,000, which the summation is appearing as a total on the outer column of our profit and loss account. Now the extract of the balance sheet is drawn up and is shown in the slide. The asset side shows sundry debtors 3,10,000 value. This is the value which is appearing in the trial balance, which is our debtors balance. From there we subtract the further bad debts amount of 10,000 and we get 3 lakhs of rupees. From this 3 lakh again the provision for bad debts amount is deducted so that we get the final value of our debtors as 2,85,000. It is to be noted that the bad debts of 5,000 rupees appearing in our trial balance, it will not come in the balance sheet because it is already adjusted with the debtors account, for which the balance of 3,10,000 has come. So this is how we tackle a provision for bad debts when it is appearing only in the adjustment section and not in our trial balance. I hope the presentation and the explanation has been clear to all of you. In my next series, which is 1B in provision for bad debts, I will be explaining to all of you how the old provision as well as the new provision will be tackled. Also, there will be 2 cases in this old and new provision. Remember, old provision is the provision which will be appearing in the trial balance and has got carried forward from the previous financial years. There could be a situation number 1 in which the value of the old provision will be more than the value of the new provision, and situation number 2, the value of the new provision will be more than the old provision. That we will see how we will calculate and depict them in the profit and loss account as well as the balance sheet. So thank you all of you. Take care and goodbye.